The stock market crashed. But what actually happened to the market? When did the market actually crash? And what could you have done to protect yourself and your investment? So yeah, the market crashed, largest drop in the history of the stock market, about 20% from here to here, rallied 85% faster than it's ever done in the history of the market from here to here. But if you guys know a thing or two about the market always crashes the fastest when it's going down and it rises the slowest when it's going up. So when did the market actually crash? So technically the crash was confirmed on February 24th and potentially February 25th. But as you can see, this is the high on February 19th and it started a 7-day downtrend and continued all the way down to the low of March 23rd. So the market essentially crashed for about a month and it rose pretty much all the way back up to the high, but that was from March 23rd to August 11th, which is where the market is now. So what you could have done to protect yourself is, first off, realize that the market crashed. This steep decline usually doesn't happen often for the market, and this pretty much usually doesn't happen very often for the market. So when you see that the market is downtrending for multiple days and the downtrends are strong, these are candlestick bars, they're strong, then that's your warning sign that the market is crashing. Also, if you're paying attention to the news might give you an update. They don't really know what they're talking about specifically when it comes to the market, but they can give you an update of whether it's going up by a lot or crashing down by a lot. And once you saw this, you could have basically taken 80% of your money out of the market or all of your money out of the market and put it in a money market fund, which is basically a government bond, a treasury note or a treasury bill, depending on how long you want to hold it. Bills are shorter than notes and bonds are longer than notes. It should depend on your time frame. So you could have taken your money out and put it in those investments until you see that the market is starting to recover. And when you see a recovery, you can put your money back in the market. But in actuality, a lot of people were expecting that the market would continue to drop. But right here you can see on April 2nd, the market continued up and it took out these bars right here on April 6th. So in order for the market to continue crashing, it should have kept going down and made a new low. But the fact that it took out these bars right here and made a new high is a signal for a very intelligent investor that the market is going back up. And as you can see, the market was just trending and trending and trending. So the market crashed on February 20th, essentially, but it was confirmed on around February 21st, February 25th, made a low on March 24th, and the crash was over, officially confirmed on April 6th, and it just kept going all the way up. Now, normally a lot of people were expecting it to go back down, and a lot of people were basically saying that halfway point of the crash would be the final resistance, as you can see across the line, and that the market would continue going down, but made a new high here on April 6th, and it broke the halfway point around April 24th, 23rd. I would say officially it was over on May 26th. It was completely over that the market broke the halfway point and was just going to continue going up. And you can see right here that whenever the market came back down, everyone who bet against the market is just have to buy back. So it keeps bouncing and bouncing, and that fuels the market and makes it go up even higher. So that's basically my summary of what happened to the market. things you could have done to protect yourself is to move everything in a money market fund or a government bond and wait for the market to rebound and put your money back in the market. And crashes are normal. A lot of people panic, especially if you're about to retire. If you were planning on retire this year, you would have been panicking. But crashes are normal. I'd say generally, if you're gonna retire soon, you want to have 80% of your money in bonds anyway, and try to avoid the market. But if you're young and you have 20 years, 30 years, or 40 years to work, then you have time to phase out these crashes. You could have held through it and then it would have recovered. But if you're retiring by March or the beginning of this year, you would have panicked, probably sold your money and lost it, and missed this up move.